The quick recovery from the global recession fueled by new vaccination drives looks to be fading. In March of last year, investors started a stunning rise in global stock markets. However, issues are arising on many fronts. It's not only the rising cost of delta fluctuation, uncertainty regarding China's housing market and development model, intensifying trade war, and global trade disruption caused by shipping restrictions are all factors. With most countries still recovering from the pain of the pandemic, what happens when we face another brutal collapse of 80%? If you are new to our YouTube channel, please subscribe and click the notification bell to avoid missing new content. Dinero Association will regularly add videos to keep you updated on the latest in business and finance. The world's massive stock market crash is about to explode with 80% drop. September is infamous for the worst month for stocks, and this year was no exception. On the other hand, October has seen some of the most devastating stock markets crash in history. October saw the 1929 Wall Street crash, Black Tuesday 1987, and the Asian financial crisis 1997. While Lehman Brothers' bankruptcy in September 2008 sent global markets into a tailspin, losses in October grew. Traders with a basic understanding of history see the trend, and anxiety nearly doubles every year. A challenging 4 weeks finished September on a high note, but the start of a new month and quarter saw a pounding nosedive that helped wipe away 4.5 months of gains. Several concerns can be reduced to two main problems. Declining global growth and scarcity are raising prices. This means that prices for everything from food to construction could go up. This video looks into the world's most significant stock market crash with a massive possible drop. The shocking 80% drop. The US stock market is unprepared for what lies ahead. Given the economy's current position and rising inflation, some investors' favorites like Rivian have already fallen by almost 80% in a few days. On the other hand, traders keep trying to blow the bubble and raise valuations. Many investors who believe the crisis is over may be disappointed to learn that the market's upward trend is reversing. Recently released data warns of imminent bond market peril. Yields are decreasing across the curve, with the 2-year rate decreasing by 5 basis points to 65 basis points. The 10-year note is declining, sliding 4 basis points to 1.45%. Most investors anticipated that inflation would subside on its own and that the economy would remain solid, so this comes as a surprise. Along with rising inflation expectations, the flattening yield curve with the front end rising and the back end falling shows that the bond market is growing increasingly anxious about an economic slowdown, or even worse, the increased probability of an oncoming recession. Financial conditions are also tightened by the Fed's announcement that it will reduce its bond purchases and raise interest rates by the end of 2021. The stock market becomes tumultuous as the financial condition index increases. On November 26, the Federal Reserve began tapering due to rising inflation, the likelihood of a global economic recession, and bond market concerns about slowing economic growth. Due to the possibility of future falls, elite investors are rebalancing their portfolios away from riskier assets and toward cash-saving strategies. Sectors deemed speculative, such as technology, growth stocks, and cryptocurrency, are under severe pressure, with current prices far above historical averages. Stock market peaks are typically the result of a process. They usually occur following significant market corrections. To most market experts, the yield curve is flattening, the global GDP is falling, The Fed is tapering and financial conditions are tightening. According to a new bank rate poll, market veterans believe the market is due for an 80% correction. Based on the recent bank rate's fourth quarter market maven study, 70% of analysts expect a stock market meltdown, and they explain why. Most bank rate survey respondents expect the S&P 500 to fall soon. Paul says that 70% believe the market is due for a considerable fall any day now. 10% think it will occur within the next year, and 20% are unsure or provide another opinion. These insiders fear the market will crash for a variety of reasons. The most usually discussed are the rising interest rates and stock market overvaluations. Since last year's sell-off, the S&P 500 has been on a near constant run, although many corporations' underlying growth has lagged behind the rate at which their stock prices have climbed. Similarly, Jim Paulson of the Luthold Group believes that investors may panic due to high valuations and less supportive Federal Reserve policies. We're long overdue for a correction, the firm's chief investment strategist remarked last week in an interview with CNBC. I'd want diversification away from the S&P 500, which I believe will take the brunt of the downturn, he explained. To put it mildly, this is not good news for the stock market. At this point, all of the pieces are falling into place and the market is on the verge of collapsing. A collapse of 80% is imminent. The time has come for a catastrophic stock market catastrophe. And the next setback will be the most agonizing in modern history. What do financial gurus have to say about the possible market crash? David Hunter agrees with Federal Reserve Chairman Jerome Powell that inflation is a passing fad. Hunter points out that this does not rule out Powell and the FOMC caving to increasing inflation in the months ahead. A 48-year market veteran, Hunter believes an economic bust is approaching due to the economy's and markets' excessive debt and leverage, and that inflation will increase to 6 or 7% before dropping. Inflation will compel the Fed to become more hawkish, he recently remarked. In September, inflation increased for the 6th straight month, exceeding expectations. The most widely cited inflation indicator, the Consumer Price Index, is up 5.4% year on year. Hunter, however, is upbeat. He recently raised his S&P 500 price target to 5,300 from 5,000, citing too bullish investor sentiment. But if inflation exceeds forecasts, everything would crumble, he said. Be calm if the market crashes. When stocks collapse and the value of individual investors' portfolios plummets, panic selling is a common reaction. As a result, it's vital to assess your risk tolerance and the impact of price fluctuations or volatility in advance. Hedging your portfolio through diversification, holding a diverse range of investments, some of which are unrelated to the stock market, is another strategy to mitigate market risk. Please share and like this content and let us know what you think by typing your comments below. Keep your notifications open and I'll see you on our next video.